Hello, happy Thursday, April 10th. I believe we are live. Yay, we are live. I know probably nobody sees it, but I'm excited. All right, so today, if you are wondering about the stock market, my diagnosis that stock market is bipolar stands. It is bipolar, it is crazy right now, so we are not going to talk about stock market right now unless you want me to. But I wanted to talk about required minimum distributions and why they are important. Yes, they are important. Why? Because at some point, if you have any type of tax deferred account, be it IRA account, 401k, 403b, 457, defined benefit plan, you name it, the time will come when the government will tell you, Mr. and Mrs. Saver, please take the money from your account. We don't care if you need the money or not. Take the money and pay us taxes. And here are the two problems. Problem number one, we don't know if you want to take money or not, if it's a good idea. And problem number two, we don't know what taxes are going to be in the future. So if you are 65 right now and your age is 75, it's 10 years. We don't know what taxes are going to be. And we don't know how big your account is going to be. Hopefully, it will double by then, but then all the distributions from that account will be 100% taxable. Problem number two, as your taxable income gets higher, you are pushed in a higher tax bracket, which affects a whole bunch of other things. Social Security, how much of it is taxable, Medicare premiums adjustments, how much of that is taxable, required charitable contributions, how much is deductible, medical expenses, how much is deductible. It all gets affected because now your income is higher. Well, let's say at 75, you have $2 million in your 401k, and it's about 4% required minimum distribution is $80,000 of additional income, which will affect your future taxes. So what do you do about it? Well, if you have a lot of time, strategic planning is always good. What we do, we convert your tax deferred accounts strategically to tax-free Roth accounts or life insurance retirement plans. Convert, move your money, pay taxes now when we know how much it is, and you can plan for it. Nobody tells you how much money to take from your account, so you can convert now. So by the time you are in your 70s, nobody gets to tell you how much money to take from your tax deferred account and how much taxes to pay. Strategy number two. Well, not everybody has the time to convert right now. Some people are already in retirement. Some people don't have money to pay taxes. Well, not everybody can convert now, right? So the other strategy is spend strategically. What I mean is, if you're already taking distributions from your accounts, from your tax deferred accounts, or if you have other accounts, if you have your regular brokerage account and tax deferred account, spend money from your tax deferred account and try, especially if you have some qualified expenses like tax deductible expenses. If you want to donate to charity, take the money from your tax deferred account. Medical expenses, take the money from your tax deferred account. What else? Even for business expenses, even if you run a business, and you need to contribute some additional capital to your business, it will be deductible eventually, right? So tax take your money from your tax deferred account. Yes, it will be taxable income. It will be counted as taxable income, but on the other hand, you will get a tax deduction. Strategy number 3, qualified charitable contributions. If you have a favorite charity and if you have an inclination to give, this is perfect. You can give directly up to $100,000 directly. The money has to come straight from your tax deferred account to the charitable organization, but your taxable income will not be affected, which means you will stay in lower tax bracket. You still will, it will be counted as your required minimum distribution, but it will not push you in a higher tax bracket, and you will not have your social security taxability will not be adjusted, your Medicare premiums will not be adjusted, nothing else will be adjusted because it will not affect the tax brackets and calculations. Well, what else? We talked about contributions, and another strategy is, if you are already in the time when you are spending money from your tax deferred accounts, reallocate the assets. Let's say you have different types of assets like bonds or assets which are very conservative and don't appreciate much. They should be in the tax deferred account. And the more aggressive growth assets should be in your tax-free accounts, like Roth accounts, or your regular capital accounts. This way, the gains will not be taxed as badly as the gains on the tax-deferred account, because remember, as tax-deferred account grows, your required minimum distributions increase, and all distributions from the tax-deferred account are taxed as an ordinary income. There is no breaks for capital gains, qualified dividends. It's all ordinary income. So there we have it. If I will be out again next Thursday at 3:30. If you subscribe to this channel, Serenity Wealth Management channel, you will get notification about, it's coming up, because I will schedule it. Or if you have some questions, if you want me to talk about something specifically, shoot me an email, let me know, and we'll dedicate the conversation to it. And I see somebody is watching. Thank you for joining. Thank you for watching. This was our first time. It will be better in the future, I promise. We are still working on equipment. We are still figuring it out. I'm excited it worked this time. All right, have a wonderful week, and I will see you next Thursday.